Hey everybody, it's Larry Berman here. Well, it's been about a month since the U.S. election. Time to take a look in the rearview mirror at one of our recommendations for investors, and two, uh, what is the market thinking here, and what might it be thinking going forward? So, we've got a Fed meeting coming up. If you go back, the last Fed meeting was on November 7th, where we got a rate cut and we got some forward guidance about a slower path. And so let's take a look into the chart room and kind of see what we can learn from the behaviors of both bond and stock investors in the past month since the election and the last FOMC meeting. So at the close of markets on November 7th, expectations for rate hikes or cuts, negative if it's a cut, was less than certain for the meeting on December 18th, which is just creeping up on us here. When you look through all of next year, you see another 2 to 3 rate cuts beyond that. If I take this back to pre-election, you get an interesting message, right? So the America First policies of the Trump victory and sweep are thought to be somewhat inflationary. They're and growth boosting. And because of that, less rate cuts are needed. So that's kind of the key message that I see here. When we roll the clock forward to today, Friday's close, we see a very similar expectation, slightly more towards rate cuts and a little bit through all of next year, which again, it's less than pre-election, but a little bit more easy relative to the Fed meeting. And when we heard from all this Fed speakers in recent weeks, we're going into blackout now. So we won't hear from many more Fed heads before the December 18th meeting. Mixed opinion. They're all open to it. The employment number that came out was a little bit on the hot side, in line with expectations, but hot in terms of pretty robust, job growth with an upward revision. So from that aspect, the labor market still firing on most cylinders. Manufacturing side remains soft, but the services side is ripping. When we look at the inflation numbers, slightly higher than expected. If I was on the FOMC, and I'm not, but if I was, I would take a pause at the next meeting. I don't think we need any more rate cuts at the moment until we get a better line of sight on inflation and implementation of Trump's administration and policies. And I think they've cut enough that markets can really overheat here, because from the bond market side, again, when we look at FOMC pre-election, so again, election, Trump wins. You got a big markdown in higher yields, lower bond prices, TLT being the long bond. Fed meeting, not hawkish, not dovish, Goldilocks just right. We came down, we tested the support, it held. Bond supply, good auction, bonds rip. So we've got bond supply in the long end coming in the next week. Markets rallied up, long bonds rallied here. Had a little bit of a pop on the employment report and basically a fade into that. We had a move during the week where it looked like we were getting a big reversal here, followed by a follow through on the next day. So, you got some bond buyers that are worried about geopolitical. You've got bond sellers that are worried about bond supply, the Fed, the data. It would be next to impossible in my mind to see the long bond up here, given, back at these levels, unless we were talking about the economy falling off a cliff. So we're actually cutting our duration significantly by selling forward option covered call strategies in and around these levels, over the next few months. And with almost virtual certainty, we expect a retest of these lows in the next few months, and very possibly the May lows. So this 88 to 90 area on the long end is we're dip buyers from a risk-off perspective. But after this recent rally, we've been selling into it. And so, bond market's in a range here. And what breaks us out of that range to the upside? Job market falls off a cliff, economy's weakening, bad for stocks, good for bonds. What breaks us to the downside is Trump policies, spending, inflation. And so which way is it going to go? And this is where I bring up the Fed. And so what do we do here? We don't know. We've got to listen to their guidance. They ultimately make the decisions. We're probably going to get a rate cut, given the market's tilted in that direction, and they don't like to disappoint. A few weeks back, we made a recommendation here and on BNN after the pullback. So we got the initial election pop, we got the pullback, and what we said at that point was, if Trump's America First policies are really about America First, then high quality domestic companies are likely to outperform. And so we recommended HSHQ, HMHQ, small and mid cap quality, large cap quality, and that tilt obviously is towards the NASDAQ type names when you get large cap quality. So I'm looking at the broad US market, everything large, mid, and small, entire universe, the Qs, and we're looking at performance since election night. And when you look at it, the Qs are on the leaderboard right now, but when you look at this green line, the Qs were a week ago, the Qs were at the bottom of the pack, and this week. So what happened this week to Goose Tech? I guess Trump met with some tech guys and some biotech guys, and they did kissy huggy at Mar-a-Lago. Don't know, but big bite, and then what he kind of actually does, and we'll see. And so there's a lot of Trump's bark is worse than his bite, and we'll see how all that plays out. But when we go back and look at TLT, there's the big difference. A pretty good rally in the bond market that really helped those long duration, tech names. So if this is going to come back down, the next really big catalyst, obviously inflation numbers coming up, Fed meeting, but the quarterly refunding announcement, which is going to be with the new Treasury Secretary, and are they going to do more bills or coupons and revert back to coupons? If they choose to do more coupons, we're going to see this taken out. If they choose to do more bills, we might see this. But this is not sustainable unless the economy goes and the labor market breaks, in which case stocks break. So those are the dynamics for the next few months, and we'll see what we see. And no strong bias, but really caution remains the message here, as the valuation problem is not going away, and at this point the market just doesn't care as long as the economy is firing and labor markets remain strong. Have a great week, everyone.